Beautiful.
A
You're
very good
live
af-
now, Bhavna. You're
Yes, ma'am.
live.
Okay. A very good afternoon to all the participants. I am CMA Bhavna Yadav from Tax Research Department, and I warmly welcome you all to our webinar today on the topic Applicability of Cost Accounting Standard 4 on implementation of GST New Regime 2.0. It is an honor to introduce our speaker for today's session, CMA Ajay Deep Wadhwa sir, a seasoned professional, academician, and thoughtful leader in the field of cost and management accounting, financial reporting, and strategic management. He has served as a visiting faculty at several prestigious institutions, including XLRI Jamshedpur, XISS, IMT Nagpur, ICSI, and St. Xavier College, as well as various government and public sector training institute. His areas of expertise include cost accounting, strategic management, accounting standard, GST, leadership, communication skills, and motivational studies. He is also an international trainer on IFRS and has delivered sessions for professional bodies such as EIRC and NIRC of ICAI. Beyond academia, he is a regular voice on FM radio platform where he shares insights on topics like Indian economy, capital market, and motivation. Sir is an published author, having written books on cost accounting standard and motivation, and has co-authored 6 volumes of Indian company law, and also a regular contributor to various professional magazine and national publication. His leadership credentials are equally impressive. He is a past chairman of EIRC of ICI, a former president of Rotary Club of Ranchi, and has served on key committees of ICAI and Coal India Limited. In recognition of his professional excellence, he was conferred with the CMA Award by ICMAI in 2015. We are truly privileged to have him with us today. Let us take full advantage of this opportunity to grow and learn together. Over to you, sir.
Thank you very much. Thank you, Miss Bhavna. I think I am audible, clearly visible and clearly audible. Am I right, Madam Bhavna?
Yes, sir.
So thank you, Institute of Cost Accountants of India, for inviting me. And this is only possible of three wonderful ladies from our institute. One is Miss Priyanka Rai, another is Miss Bhavna Yadav, and third is Debosmita. So thank you, Institute, and thanks to all the wonderful ladies and employees, officers of our institute for inviting me. And I am also thankful to the participants who have found out time to listen me on cost accounting standard 4 and impact of GST on CAS 4. So friends, let us start our discussion. What I will do, I will divide my session into 3 parts. First will be, first part I will discuss CAS 4. And then in the second part, I will try to discuss the impact of CAS 4 on GST, or in other way we can say impact of GST and CAS 4. What is the relationship between these two? And as a cost accountant, as a cost auditor, what we have to take care of. And third, which will be a short session, we can discuss any point which you want to discuss with me. That is small question and answer session. One more thing, I am not claiming that I am an expert of cash flow. I have written a book of cost accounting standards, but it was many years back when the cost accounting standards in 2012, when the first time cost accounting record rules were announced and implemented very strictly in our country. At that time, with the permission of our institute, I had written a book on cost accounting standards. And after that, a lot of changes in cost accounting standards have taken place. So I am not never claiming, I never claim that I am an expert, but I am I am like you. and we all are here to discuss the nitty-gritty of CAS 4. Moreover, I am also a cost auditor. Right now, I am cost auditing the cost records of two or three big, government companies as well as private companies. So based on my experience, I will discuss everything. And if you find that any point is not clear to you, or if you think that any point needs to be discussed, especially, so we are ready, we can discuss. Because it is an era of, I always tell, it is an era of triple L, lifelong learning. And we have to improve ourselves. Improvement is a continuous process. And for that reason only, I think this webinar is organized. These type of webinars are organized by our institute, that is Institute of Cost Accountancy. So friends, these are the three parts of our today's my discussion, and let us start our discussion with CAS 4. First, I will discuss, although I'm repeating, you all are cost accountants, so you are fully aware of what is CAS 4. But still, I would like to discuss it with you, because if some, if you do not deal with a particular subject in for many months, then we tend to forget that thing. Just that is the reason I am starting my discussion with CAS 4. What is CAS 4? What are the provisions of CAS 4? As an accountant, if we are preparing the cost records, what important points of CAS 4 should we consider? And if, as a cost auditor, if we are auditing the cost records, then we have to again take care of cost CAS 4, that whether it has been implemented or not. Because now across the world, compilation is become very compilation, and following the rules have become a norm. uh, you know if we are not following the rules, then we are in deep trouble. I think you all are aware that a lot of complaints have been made against many auditors in NFRA. I am not taking the name of any profession, but a lot of complaint has been made. And last year, I came across a very typical case where one company was facing this is just I am sharing with you this case study, a very small case study. Then I will come to CAS 4, just to emphasize that what is the role of we auditors if we are auditing the accounts and we are not ensuring the CAS, whether it's the CAS 1 or CAS 2. Last year what happened? One auditor audited the accounts of a particular company, and that company was having a that was a company, a state PSU, a small PSU, state level. Their profit was not very high, and that company was having a lawsuit in a high court. But this fact was not disclosed either to the auditor or to anybody, and it was never mentioned in the accounts also. Now we all know that it's the duty of auditor that when you are auditing the accounts, you should obtain a certificate, a list of all the pending cases from the legal department of the company or from the auditee. And moreover, it is also the duty of auditor to seek the opinion of auditee, that what is the status of each and individual case, so that either provision of any probable expenditure can be made in the books of accounts, or if there is a very very less chance of losing the case, then at least contingent liability can be created. But that particular auditor failed in both the things. Neither he made a provision, nor he mentioned this about this case, the probable the probable about the probable liability of this case in his auditing report. He did not mention it as neither as a contingent liability nor as a provision. So ultimately, the accounts were passed. It was circulated all across the world. Accounts was accepted. But later on, what happened? The company lost the case. In the next financial year, that state PSU lost the case, and they were forced to spend a good money in crores to the other party. Now, in between, one banker gave loan to that state PSU on the basis of its financial accounts. And since in the financial account there was no mention of contingent liability or there was no provisioning of such case, so bank thought that it is a clean company and they gave a very good loan to that company. But within next year, within 1 year, the company lost the case and a liability came up. Court ordered the company to pay a very good amount in crores to another party. Then this PSU wrote a letter, or they requested the bank officials to delay the repayment of loan, to delay the repayment of installment, because they have faced a financial liability because of court order. Now bank made a complaint that if the PSU was having a court case, it should have been mentioned in the auditing report, either in the form of provision or in the form of at least contingent liability. Since nothing was mentioned, so they gave very huge loan to PSU because they were not aware that a case is going on and it may go against the PSU. And ultimately, case was given to NFRA. NFRA, you know, might have invited the auditor, but I don't know what happened. Ultimately, NFRA imposed a penalty on auditor. He was debarred from auditing or accounting for 5 years. His qualification certificate was withheld by NFRA, and moreover, he was imposed with a penalty of 25 lakh INR, Indian national rupees. So this is a simple example, and it is an example of last year, that we auditors, if we are a cost auditor, even if we are a cost accountant and a cost accounting standards or general acceptable cost accounting principles or any guidelines of the government is there, it is our duty to, to ensure that orders are being followed. And if company is not, our audit is not, accepting our views, then we should mention it in our report. We have to qualify the report accordingly. Now, with these words, let us start discussion on CAS 4. First, we will discuss CAS 4 and then we will come to GST portion. Now, so for CAS 4 is concerned, we know that it is a cost accounting standard on cost of production, acquisition, supply of goods, and provision of services. Basically, the objective of this standard is to bring uniformity and consistency in the principles and methods of determining, the cost of production. It is like any other cost accounting standard. The purpose is same. Basically, what happens, many times companies procure, or many companies obtain uh, product or services. They takes products and services from the other unit of the same company. It means it is some sort of, internal consumption. Now, at what value that internal consumption should be shown in the books of accounts, that is an issue which is addressed under, which has been tried to be addressed under CAS 4. And what is the role? Suppose you can ask a question that suppose why so much, because suppose a company is having two unit. One unit is producing a product, and the finished product of one unit is the raw material of another unit, or the service of one unit is the raw service required for another unit. So it is a some sort of, intra company transfer, means one department is transferring goods to another department. Then why so much emphasis on cost and value of that transfer? I can give you one example, and then we will go to the, one example. Earlier I was working in, coal industry. I was working in Coal India Limited, and I was also involved during some period I was involved in coal pricing. And in Coal India, we used to sell two type of coal. One, we sell raw coal. Raw coal means it is produced from the mine and it is dispatched or given to customer as and where basis. Means it is produced and sold to the customer immediately without adding any valuation. The second type of coal is, which is called coking coal. This coal is basically, coking coal is in shortage in India. Coking coal is a little bit costly and good quality coal, and it is not available in India. And coking coal is used by steel sector. All these steel plants, especially the steel plants of Steel Authority India Limited, Rourkela, Bhilai, Bokaro, Durgapur, Banpur, they use coking coal. Apart from that, private parties, Jindal, or Tata Steel, they also consume coking coal. They use it as a raw material for producing their steel. Now, the coking coal, as I told you, is not available in India. Very small quantum is available in the state of Jharkhand and a little bit in Odisha. Now, in India, the coking coal is available in limited quantity and its quality is also not very good. One ton of coal you may be having 20, 25, 28, 30, 34% of ash percentage. If ash percentage in a coal is high, it means its carbon percentage is low. It means the burning capacity of coal is low. So if in a good quality of coking coal, the ash percentage will be low and carbon percentage will be high. On the other side, in the bad quality of coal, ash percentage will be high. In India, ash percentage is high. It is, I also told you, it varies from 28% to 35%, or sometimes more than 35%. Now, the Australia provides the same coal, coking coal, to India at 7%, 8% ash percentage. So quality-wise, their coal is very good. So what the Coal India does, it produces coking coal from the mines, and then it is transferred to washery department. And where it coal is further washed, means value is improved. Ash percentage is lowered by the company, and carbon percentage is improved, and then it is supplied to the, supplied to the, to the steel plants. So at one point of time, when I was involved in this process, when we were deciding the coal prices, we decided that if we do not supply this coal to steel plants in India, what they will do? They will import from the foreign market. And if they import from the foreign market, it will be very costly for them. I exactly recall that at that time, the average selling price of our coal was 2,400 to 2,500 per ton. And in international market, that coal was available at I think at 110, $112. Let us take is $110. And at that time, suppose $1 was equivalent to 70 rupees. It means 1 ton of coal was available in international market at 7,000 to 8,000 rupees. And we were selling it in India at 2,400 to 2,500 rupees per ton, excluding taxes, excluding taxes. So taxes is applicable in all cases, whether you import or you produce indigenously. Then we decided that why we are supplying such a cheap coal, such a low rate to steel plants. So we took a decision that we will increase the prices of coal, and we increased. Now this increase in price of coal was not accepted by many clients, especially Steel Authority India Limited. And they made a lot of complaints. They argued a lot. They had a lot of meetings with my company, then ministry, and ultimately this case was given to PMO. Now, in during this process, all the time, Coal India was asking for, sorry, Steel Authority India Limited was asking for the cost sheet. They wanted to know that why have you increased the prices? What is your cost of production? And since our cost record, cost records are not public documents, we cannot share it. So we did not share our cost records with the sale. But you know what they were asking? They were saying that so far raw coal is concerned, we know the price because you are selling that raw coal to powerhouses and other parties. But we are not sure about your washing charges. And they were having that we are not implementing, since it's a case of internal transfer, we are transferring coal from mine to washery, which was another unit, another cost center. So they were of the opinion that we are not following CAS 4. So that is the reason they were asking for our cost sheet. I give you this example that we have to follow cost accounting standards, and CAS 4 is very important because if we are not valuing our internal transfer or intra company transfer of one department to another one properly, then it can impact our prices also, and sometimes some sort of litigations can be attracted. Now come to CAS 4. So that is the purpose of CAS 4. That is the purpose of CAS 4. that it it gives authenticity to our cost of production. It gives authenticity to the price, to the transfer price. The cash flow is basically applicable on determination of cost of production of goods, cost of acquisition of goods, cost of supply of goods, and cost of provision supply of services, etc. Now, basically, like any cost accounting standard, a lot of definitions have been given in the CAS 4. I am not going to, read these definitions because uh, we all are cost accountants, so we know all these terms: abnormal cost, actual capacity utilization, because the capacity utilization is very important. Otherwise, if we are not utilizing the capacity properly, that it can increase our cost. So actual capacity utilization, administrative overhead, allocation of overhead, amortization. So these definitions have been given like any other cost accounting standard in CAS 4 also. Apportionment of overheads by product cost, cost of purchase and acquisition, cost of production of goods, then cost of provision of services, defectives, reworks, rejects, depreciation, development cost. Basically, we all know that any company incurs expenditure on research and development. So as per IFRS, here we have to follow the guidelines of IFRS also. IFRS says that, so for research cost is concerned, it is shown as expenditure in PL account because most of the research work fail. They do not, they do not result in that. Most of the research cost does not result in either in the in a successful product or in a successful service. So that is the reason research cost is shown as expenditure in PL account. But so far development cost is concerned, development cost on takes place only when a research becomes successful, or suppose we go for development cost of any existing product. So if we are researching something, we are trying to find out some new products, or we are trying to find out new values, generation capacity of old product. So most of the research fail. But if research becomes successful, then companies spend money on development cost for the for the making, converting that developed technology into a product. So development cost is very important, and its accounting is very important. So development cost. So as per a CAS 4, development cost is the cost for application of research finding. Means once research is over and now finding is positive, then it is the cost for application of research finding or other knowledge to a plan and design for the production of new or substantially improved materials, devices, product, process, system, or services before the start of commercial production. In normal circumstances, development cost is capitalized. Development cost is capitalized. So research cost is basically an item of PL account, and development cost is it is a capitalized. It is added in the value of product which is generated. So development cost, then CAS 4 also defines employee cost, excess capacity utilization, idle capacity, installed capacity, interest and finance cost, joint product, normal cost. Normally, we all know that interest and finance cost are not the part of cost of production. So they usually find place in reconciliation statement. They are not the part of cost. Overheads, packing material cost. So these are, these have been defined in CAS 4, and it has been defined in any other cost accounting standard, and its definition is same. Then material consumed. Material consumed includes material directly identified production, indigenous material, imported material, barter material. Then material cost, repair and maintenance cost, quality control cost, research cost, production or operation overheads, royalty, scrap, selling overhead. So for royalty is concerned, we all know that royalty is given to the owner if we are using the any asset of other person, then we have to compensate that person with an amount. That usually that amount is known as royalty. Suppose you have taken a mine from government, so you have to pay a certain rent to government every month or every year. So that is called royalty. The scrap, selling overhead, standard cost, support service cost centers, technical know-how fee, waste and spoilage. So these are the definitions which have been given in CAS 4. and we all know about this. Now we come to the exact CAS 4. In any accounting standard or cost accounting standard, or in any accounting, the biggest problem is principle of measurement, because how the at what value the figures will appear in the books of accounts, that is very important, because as an accountant, it is our duty to show the value of any product or anything, any cost, any item correctly. So principle of measurement is very important. Now, CAS 4 says, we will come to, let us, first I will complete CAS 4, then I will come to GST portion also. Now, principles of measurement, cost of production, CAS 4 says that costs of production or acquisition of goods or provision of services shall be measured for each type of goods or services separately. Now, if any company is producing two or three, product which is consumed by the other departments of the same company, then we have to calculate cost of production or cost of acquisition separately of each and every product. Cost of production, acquisition, or supply of each type of goods shall be aggregate of direct and indirect costs relating to the production. Now, while calculating the cost of production of a particular unit, particular product, particular service, we have to calculate total cost. Means we have to we have to add direct and indirect cost both. So for cost of provision of each type of service shall be concerned, it shall be aggregate of direct and indirect cost related to service activity. Same thing has been repeated. Then material cost shall be measured separately for each type of material, that is for indigenous material, imported material, bought out components, processed material, self-manufactured. Suppose if we are using certain raw material. You see, again, I'm repeating, what is the problem? Suppose department a company is having two departments. Department A is producing certain products which are used by department B as a raw material. So now we are finding out that at what price, what value the material will be shown as transfer from material department A to B, at what value, what will be the transfer price. So CAS 4 gives advice on that. So we are discussing that only. So material cost shall be measured when we suppose department A is producing any product which will be used by department B of the same company, but department A is definitely using certain raw material for produce its departmental product. So that material cost should be, if purchase cost means purchase, whether we have purchased it from the indigenous market or we have imported it from the foreign market. And the material cost of normal, scrap, defective, which are subject shall be included in the material cost of goods produced or services. We all know that normal cost is added in the cost of production, mean it is borne by the customer. So the same thing is being repeated by the CAS 4, that the material cost of normal, scrap, defective, which are rejects, shall be included in the material cost of goods produced and service provided. The material cost of actual scrap defective not exceeding the normal quantity shall be adjusted in the material cost of goods production. And realized or unrealized value of scrap or waste shall be deducted. We all know that is a normal accounting practice, that the cost of normal wastage is added in the cost of production. But if that normal wastage is sold in the market, suppose they are having certain customer in the market, and they realize certain value from the market, then that realizable value of scrap or waste, that will be deducted from the cost of production. It means, suppose I am producing a product and I am producing, there is a wastage, normal wastage of 100 rupees. So this 100 rupees will be added in the cost of production. But this wastage has been sold at rupees 12. So basically 100 rupees will be added and 12 rupees will be deducted. So net 88 rupees only will be added in the cost of production. So CAS 4 says that cost of normal wastage, normal loss will be added in the cost of production, which will be borne by the customer, because accordingly prices of the product will increase. But if we have sold the wastage in the market, normal loss has been sold. So whatever value it has generated, it will be deducted from the cost of production. Material cost of abnormal, scrap, defective should not be included in the material cost, which is like any other, which we all know. So for material cost of abnormal, scrap, or defective is concerned, it is not added. Then employee cost for each type of product or service shall be measured separately. Basically, if we are, suppose department A is producing two products, which will ultimately become the raw material for department B. So Department A will calculate the cost of production of two materials separately, and they will prepare two cost sheet for each product separately. And each cost sheet will show the employee cost of each type of goods separately. So for the cost of utilities consumed for the production, acquisition, or supply of each type of goods or products or services shall be measured for each type of utilities separately: power, electricity, water, steam, and gas. And if for the production of that goods, any utility is being used, utility means power, electricity, water, steam. Either it is purchased from the market or it is being produced at the local level. Their cost will also be added. And cost of packing material used for the production or acquisition or supply of goods or provision or service shall be measured for each type of goods or services separately. If goods are transferred, dispatched, or supplied during duly packed, the cost of such packing shall be included in the cost of good transferred, dispatched, or supplied. Basically, we all know that we divide the packing material cost into two parts. One is direct packing materials, another is indirect. I give you a very small example. Suppose toothpaste. If you sell the toothpaste openly in the market, if the producer of toothpaste they supply toothpaste in a drum, then nobody will purchase it, because seller will take some. Suppose a customer comes for purchasing 100 gram of toothpaste, and if the seller takes 100 gram of toothpaste in a spoon from that drum, and then it measures, people, because we use toothpaste in our mouth, so people will not purchase it. So that is the reason toothpaste is always sold in a tube. So tube, without tube we cannot sell the toothpaste. So tube is the primary packing material, and its cost will be added. But so far other material is concerned, which enhances the esteem value of the product. Basically, it is not only cash flow. All the cash flow says that there are two types of value. If we are making an expenditure, that expenditure generates two type of value: use value and esteem value. Use value is added in the cost of production. Esteem value may be your material, maybe your sales and marketing cost or any other cost. It is not added in the cost of production. So same thing has been repeated in cash flow also. Now, direct expenses for the production, acquisition, or supply of goods or provision of services shall be measured for each type of goods or services separately. High value spares shall be recognized as property, plant, and equipment when they meet the definition of property, plant, equipment, and depreciated accordingly. Otherwise, such items are classified as inventory and recognized in cost and when they are consumed. Suppose suppose company is producing a certain product in department A, which will be consumed by department B. Now, while producing the product in department A, companies is purchasing certain high value spares. Now, companies purchasing certain spares. If these spares are half high value, means if these spares are used in the machine, they will increase the value of machine. So high value spares are added when they are used. They are added in the cost of, usually this is the usual practice. They are added in the cost of machine. So they are capitalized. But so far small items are concerned. Small means small by value. Small items, spare parts are concerned. They if they are used in the machine at the time of repairing or maintenance, then their cost is added as cost of production. The repair and maintenance cost for the production, acquisition, or supply of goods or provision or services shall be measured for each type of goods or services separately. Depreciation and amortization cost for the production, acquisition, or supply of goods or provision of services shall be measured for each type of goods or services separately. Now, this is very important. Sometimes a confusion arises that in the while calculating the cost of production, where the product is being ultimate product, finished product is being used by the same company by the other department of same company. So whether depreciation and amortization cost should be added or not, that is very important. Now, CAS 4 has clearly given the guidelines. It says we all know that what is the difference between depreciation and amortization. Usually, depreciation what is used for tangible assets, and amortization what is used for intangible assets. Now, it says, CAS 4 says that depreciation and amortization cost for the production, acquisition, or supply of goods or provisions or service shall be measured for each type of goods or services separately. And depreciation of an asset begins when it is available for use, when it is in the location and condition necessary for it capable of operating the manner intended by management. So this has been given. So this means we will include the cost of depreciation also for knowing the total cost. And so for research and development cost, we have already discussed. Cost incurred for the production, acquisition of supply of goods or provision of services after split up point shall be measured for each type of joint. Sometimes, suppose again, company A is having two department, and department A, its product become the raw material of product B and department B. Now department A is producing two or three products, and some costs are common cost. So we will use the normal costing methods to bifurcate, to apportion the joint cost between the two or three cost products, because then we have to find out, certain methods have been already been given in the accounting guidelines, that how the joint costs are apportioned in the products, in between the products. So that same accounting principles will be adopted here also in CAS 4. Royalty and technical know-how fee for production, acquisition, or supply of goods or provision of services paid or incurred in lump sum, or which are in the nature of one-time payment, shall be amortized on the basis of estimated output of benefit to derived from the related technical know-how. So for royalties and sites concerned, basically they will be treated as capital item, and they will be amortized. And royalty paid as a consideration for use of asset or technical transfer in any form will form part of cost. However, royalty paid on brand image shall not be part of cost. If we are, if we are we pay royalty. Suppose, again, I give you one example. Suppose we were producing raw coal from the coal mine, and royalty is paid on the basis of production. Royalty is paid to the government by the mining companies on the quantity of production, means whenever they produce the mineral, they have to pay the royalty. And royalty is paid as either as a VAT valorem or as a whatever. So if one department of company is paying certain royalty, which is depending upon the volume of production, then it will become the part of cost. Otherwise, if it is a fixed royalty, then it will be capitalized. It should be capitalized, and it should be amortized in the due course of time. Means during the lifetime of that royalty. Means suppose we have obtained a mining right from the government, and we have paid a fixed royalty for 10 years. So now we will depreciate or amortize the royalty, the amount which we have paid to the government for obtaining the mining right, that will be amortized in the life of, means in our example, within in the next 10 years. But if royalty is paid on the basis of number of units produced, then it becomes the part of cost of production. Quality control cost is, so for quality control cost is concerned, CAS 4 says that quality control costs incurred in-house for the production or acquisition or supply of goods or provision of services shall be the aggregate of the cost of resources used in the quality control activities in relation to each type of goods or services. The cost of resources procured from outside shall be determined in invoice. So that is the normal procedure which we follow, and same has been explained in CAS 4 also. And again, CAS 4 has clearly says that so far any abnormal cost is concerned, where it is material and quantifiable, if we are not able to identify that whether it is a cost of normal loss or cost of normal loss, then we are helpless. Then it may become our part of cost of production. But if any abnormal loss, we all know abnormal loss is a loss, abnormal cost is a cost which can be avoided. Normal cost cannot be avoided, but abnormal cost can be avoided. So any abnormal cost where it is material and quantifiable will not become the part of cost of production. It will be borne by the company as a loss, but will not become the part of cost of production. And similar with the interest and other finance costs, it is a general guideline in all cost accounting standards that interest or the finance cost also do not become the part of cost of production. Impairment loss on assets shall not form a part of cost of production, acquisition, or supply of goods or provision. Now, this is an important guideline of CAS 4, which we have to keep in our mind, that impairment loss. Now, we all know that what is impairment loss. Just to remind you, just for your remembrance purpose, impairment loss is the loss which is suffered by the company, which is suffered by a particular asset due to any wear and tear, extra wear and tear, or in a short sentence, I can say that impairment loss is the reduction in the value of assets over and above the normal depreciation. Again, I'm repeating, impairment loss is the reduction in the value of any asset over and above the normal depreciation. Because when we use any asset, we charge depreciation. Or if we are using any intangible asset, we charge amortization. But sometimes, and one more thing, friends, if you think carefully, we charge depreciation. Now, how do we charge depreciation? We never, this is a particular problem of cost accounting. This is a particular problem of accounting as well as a particular problem of cost accounting. We chart depreciation using one formula because we do not know the exact amount of depreciation. Suppose I purchased two vehicles for my company, and one vehicle is being driven by my loyal driver who is very loyal and who is having ownership feeling, and he drives the vehicle assuming that it is his vehicle. But other driver is careless and he goes for rash driving, rough driving. Now, at the end of 1 year, the depreciation, the reduction in the value of both the vehicles will be different. The careful driver was driving the asset very carefully, so this asset will not lose much value due to passage of time or due to wear and tear. But the vehicle which was being run by the careless driver will lose more value. But so far depreciation is concerned, we will follow the same formula and we will calculate the same amount of depreciation. So this is a very bottleneck of depreciation, that depreciation is not a actual reduction in the value of asset. It is a calculated value of reduction in the value of assets. So for impairment loss is concerned, it is over and above that normal depreciation which we charge. I think you know that there is a accounting standard in INDAS and IFRS on impairment of loss. Impairment loss is calculated. It is a basically difference between the carrying amount and uh, recoverable amount any asset. Impairment loss is the difference between carrying amount and recoverable amount of an asset when recoverable amount is less than carrying amount. Suppose an asset is appearing in my books of accounts at 1 lakh rupees, but recoverable amount of this asset is only 75,000 rupees. So now it is a case of impairment of loss. My asset has lost value by 25,000 rupees and it will be shown as depreciation in my income statement. Now, so for this is just for you all know, this is just for your just for your remembering purpose, that so far recoverable amounts is concerned, it is higher of value in use or fair value. I think we all know that under IFRS, a lot of emphasis has been given to fair value. IFRS talks about fair value. IFRS says that whenever we will show any asset or liability or any item in the books of accounts, at every closing date of accounts, we have to find out the fair value, and we have to show that asset in our books of accounts as fair value. Now, this particular IFRS says, so far impairment is concerned, it says that at the end of financial year, we have to find out the fair value of that asset, and then we have to calculate value in use. If we keep on continuing this asset in our business during the remaining life, then how much value it will generate. Higher of these, fair value and value in use will become the recoverable amount. And if recoverable amount is less than the carrying amount, then it is a case of impairment loss. Now, CAS 4 says that impairment loss will not become the cost of production. Means for the calculation, the cost of production of internally transferred goods, impairment loss, if impairment loss is there, it will not be included. So it will not become the part of cost of production or acquisition. It further says that cost of production, acquisition, or supply of goods or provision of service shall include cost of inputs received free of cost or at concessional value, net of input tax credit. Now here GST is coming into the picture. While calculating the cost of production of internally transferred goods is concerned, if we have received for the production of internally transferred product, if we have received any raw material at free of cost or net at concessional value, it cost of input received, it cost will be added. Net of input cost in net of input tax credit means if we have received any input tax credit ITC on that product, then it will be reduced from the cost of that product. From the recipient of goods or service and amortization cost of free tools, ties, patent, drawing, blueprint, technical, and the like, whatever sorry, goods or provision of services. Means cost of production, acquisition, or supply of goods or provision of services shall will be included net of input tax credit. So while calculating the cost of internally transferred goods, we have to add the value of those goods also, which we have received free of cost or at concessional value, but after deducting any input tax credit. Cost of production, acquisition, or supply of goods or provision of services shall also include cost of rework, reconditioning, retrofitment, production or operation overheads, and other costs allocable to such activity, adjustment for stock of working process, and recoveries from sale of scrap and wastage, and the like necessary. And subsidy of grant or incentive any such amount received or receivable from any entity other than the recipient of goods or service with respect to any element of cost shall be deducted for a settlement of the. And while calculating the cost of production of internally transferred goods, if we have received any subsidy or any grant or any incentive, then that will be deducted from the cost of production. Means whatever amount we have received from third party or from the government, that will be deducted from calculate for at the time of calculating cost of production of internally generated and internally transferred for another unit, the cost of that. I mean, if we are producing any product for internal consumption, then from the cost of that production, we will deduct the subsidy or grant or incentive, if any, we have received. Any grant recognized as deferred income in the financial statement shall be also be reduced from the relevant element of cost production, the cost of acquisition. So far, grant is concerned, another there is an IFRS. So now, based on the different provisions of that IFRS, discussion has been given here. One more thing, fine, penalty, damage, demurrage, and similar levies paid to statutory authorities or other third parties shall not form part of the cost of production. So in the cost of production of internally generated product, we will not add any fine, penalty, etc. It will be shown in the PL account as expenditure or as a loss, but it will not be added in the cost of production of internally generated product. CAS 4 further says that the forest component of imported material or other element of cost shall be converted at the rate on the date of transaction. Because sometimes for producing the product, which will be ultimately consumed in my factory itself, for generating that, product, we can purchase certain parts from the international market. And when we purchase from the international market, we pay in foreign currency. Rather, we pay in Indian currency and that is converted into foreign currency. Suppose we have purchased certain products from the China. Now we are paying in INR, but party is receiving the payment in yuan or renminbi, whatever name we call it. That is the the currency of China. So, and we all know that conversion rate of two currencies always change, not on daily basis, rather per minute basis. Every minute the conversion prices changes. So, and on the for the whole day, one average price is decided by the regulatory bodies. Suppose if you ask RBI that what was the average conversion rate of rupee into dollar yesterday, they will give you the average conversion price. So here CAS 4 says that the forest component of imported material or other element of cost shall be converted at the rate on the date of transaction. Means that because every day different prices, different conversion rates are there. So we have to take the rate of date of transaction. So for credit or recoveries relating to any element of cost including the facilities provided to outside parties which are material and quantifiable, shall be deducted from the total. So any credit, any grant, any subsidy, any recovery, that will not be added in the cost of production. That will not the part of cost of production. So similar guidelines have been given on WIP and progress cost. So friends, this was the guideline of CAS 4. So far, cost of production of that product is concerned, which will be ultimately consumed by in the factory in the same company by another unit. Now, I will come to the GST also portion, but some discussion. Let us have some discussion on assignment of cost also. That assignment of cost of production acquisition, CAS 4 talks about assignment of cost. The cost of production acquisition or supply of goods or provision of services shall be determined on normal cost basis. For this purpose, any normal that we have already discussed. While assigning various elements of cost, traceability to goods or service is an economical feasible manner shall be guiding principle. Sometimes what happens if you are purchasing raw material or incurring any cost for two or three products, then it is always good to identify that which cost belong to which product. It is always good. It helps us in calculating the right cost. But if that is not financially viable, it is not easy, then we can apportion the cost or assign the cost into different products on a holistic manner, in a well accepted manner. So logically, any common cost should be allocated first on actual basis. If that basis is very costly or not available, then we can use the assignment and apportionment on some logical basis. And similar, some other types of cost, the variable production operation overhead shall be absorbed based on actual production. The fixed production operation overhead and the similar types of fixed cost, quality control cost, research and R&D cost, and administrative overhead relating to manufacturing shall be absorbed in the cost of production, acquisition, supply. So whichever is higher, so that guidelines have been given. Now, so far, assignment of cost of producing or acquisition or supply of goods or providing services which are not directly traceable to the goods or services shall be based on. Now we know that like any other cost accounting standard, if we are not in a position to assignment the common cost among different products on a rational basis, then we can use either of the two principles. One is cause and effect. That what is the cost is the process or operation of activity and effect, or we can use another method, another principle, that is benefit received. So far, we all know that what is these two principles. What is the two principles, cause and effect and benefit received, that we already know, because these principles have been discussed in almost most of the cost accounting standard. Then if there is a joint product, that has been discussed. So friends, participants, listeners, this was the main point of cost accounting standard 4. And like any other accounting standard or like any other cost accounting standard, presentation part is also very important, because all the cost accounting standard and IFRS on INDAS or whatever accounting standard, they have their last chapter as presentation. It is an era of disclosure. We cannot hide anything. So presentation also is very important, that whatever methods, whatever methodology, whatever modality we are following for maintaining our cost records, that has to be disclosed properly to the users of cost records, users of cost accounting statements. So for that, different appendix have been given in this CAS 4 also, which I can show you, but you can easily understand that how the cost of production is calculated. Cost appendix A talks about statement of cost of production with taxable goods. Then appendix 2, appendix 3. So these are presentation which we have to make like any other cost accounting standard. Further, it says now we are entering into the era of GST. Right now we discussed. So first part of our discussion is almost over, where we discussed and try to understand CAS 4. Now we are trying to enter into the field of GST, where the CAS 4 and GST relationship starts. Where the relationship between CAS 4 and GST starts. In cases where it may not be possible to determine true and fair cost of goods or services at the time of supply of such goods or services, or both, the company should compute the cost on budgeted estimated standard cost basis, and the cost accountant may issue provisional cost certificate on such basis. In such cases, final certificate shall be issued after costs are finalized. In case of any variation in the cost and hence the value of goods or services, the supplier shall issue a debit or credit note as per provisions of Section 34 of CGST Act. We all know, friends, that and in GST we cannot cancel any bill. Any, when before the CGST, before the introduction of GST, if suppose our bill was having any problem, then most of the time we would cancel the bill. Practically, I was involved in that process, and we would cancel the bill, or we will issue a supplementary bill. If we have to claim certain extra amount from the customer, we will issue a supplementary bill. But after the GST, this process has been finished. This process has been stopped. Now we cannot cancel any bill. Rather, we have to issue. We have if you have to cancel any bill, we have to issue. Subsequently, we have to issue a credit note. And if we have to increase the value of bill, then we have to issue a debit note. So all the bills may be followed by either debit note or credit note, or in some cases, exceptional cases, maybe both. So IS4 says same thing, that in GST era, if we have used any estimated cost, and after that confirm cost comes, it may be more than the estimated cost or less than the estimated cost. So what we will do, we will adjust that more or less part of the cost with the debit or credit note, as the case may be. Then then certified cost statement shall be presented with the following periodicity. In case of registered person whose aggregate turnover in the preceding financial year did not exceed the limit prescribed in Section 10 of the CGST Act, the certified cost statement shall be issued for a 6-month period. For example, cost for April to September shall be certified in March of the same year. But in case of registered person whose aggregate turnover in the preceding financial year exceeds the limit prescribed in Section uh, in first, I think in first clause, it should be in case of non-registered person. That is a typography mistake. Now, in case of registered person whose aggregate turnover in the preceding financial year exceeds the limit prescribed in Section 10 of the CGST Act 2017, certified cost statement shall be issued on a quarterly basis. Cost for July to September shall be certified in June of the same year. Certified cost statement shall also be issued for the completed financial year annually based on audited accounts on before the 31st of the next financial year. Further, the cost statement shall be prepared by the management and authenticated and signed by any key MP, key management personnel in case of company, partner in case of partnership firm, and proprietor in case of proprietary firm. The statement shall be certified by cost accountant practice of the same is duly authenticated as above. Many times, why we are discussing this, I will come to that point. Why we are discussing this particular slide, I will come to that after some time. Meanwhile, let us first complete this slide. Then what is the use of this slide? Why we have added this slide? I will discuss after some time. The statement shall be certified by a cost accountant in practice after the same is duly authenticated as above. The certificate may contain any qualification or disclosure as required. So disclosure form is again disclosure is also part and parcel of all the IFRS, all the cost accounting standards. Whatever modality, whatever method we adopted, that should be disclosed in the notes of the accounts. Now these are the appendix which we were discussing. Now we are coming to GST portion again. That what are the meanwhile I come to the GST portion. Do you have any query? Do you want me to discuss anything on CAS 4 which we have discussed? Any participant, any point which you want to discuss with me? Right now, I am able to see that 185 attendees are attending the session. Any query from anybody up to this first part? Then we are going to discuss the GST portion. Okay, I hope there is no query. So let us come to the next portion of our discussion. Now, what are the provisions under GST so far CAS 4 is concerned? What are the provisions under GST? Let us see first impact on stock transfer under GST. Businesses are charged GST on stock transfer. As per GST Act, all the stock transfer means if the finished product of one unit or any product of one unit is being transferred to another unit of same company. This is stock transfer and this is subject to GST. It is crucial to have a strategy in place to reduce tax burden. Now, this is the strategy. This is a guideline. First is fact. If you see this slide, impact on stock transfer under GST has been shown under under 2 points. First point say that it is a fact, it is a reality that businesses are charged GST on a stock transfer. Now, second is not the part of GST Act. Second is for our understanding. It is crucial to have a strategy in place to reduce tax burden, as it is quite common in any business to transfer stock to its other branches, units, depots, warehouses to cater to timely delivery orders from different geographical locations. Because nowadays it is very common. It is very common in a business that the one part of the business is transferring certain goods to another branches, another units of the same company and same business. And all these transfers will attract GST. So we had to make a strategy to minimize the nitty gritty and minimize the troubles due to that impact. So now it's here a strategy. We have to cost account has also become a strategic manager to ensure that transfer is taking place and GST liability should be at minimum. So we have to work as a strategic manager here also. Now, so far before GST regime is concerned, before GST, before 1st July 2017, under the pre-GST scenario, interstate or intrastate stock transfer was subject to levy of excise duty on the removal of goods. Suppose I was working in a coal mining company and we were producing coal in the collieries, in the mines. And from those mines, coal was being transferred to washeries, another units for further washing, means further value addition. Now transfer, this transfer may be interstate or intrastate, but these all transfer were subject to excise duty. We all know that before GST era, excise duty was applicable on the goods manufactured or produced, and excise duties would become applicable, would be charged immediate after the production. Means your production once leave the production site, excise duty would be chargeable, would be calculated. It means, suppose I give you another example of my company, that suppose we produce certain coal in a mine and then we transfer this coal to another unit where the coal is added with further value, means coal percentage, ash percentage is reduced. But this transfer will attract excise duty, because as soon as coal will be produced, excise duty will become payable. So under pre-GST area, excise duty was applicable. But this is not the case of, this was not subject to VAT and CST. After excise duty, usually on goods of production, on the production, excise duty was applicable, and when the goods were sold, then sale tax or VAT, whatever the case, it was there. So when we would transfer the goods before GST era, before the GST, pre-GST scenario, when we would transfer the goods from one unit to another unit, excise duty was applicable, but VAT or CST was usually not applicable because it was not a sale. But under GST regime, this fact has changed. Now, under GST, excise duty and sale tax has been combined. All the taxes have been merged and one GST regime is there. One GST is there. Under the GST regime, tax is collected on the supply of goods with or without consideration being paid or agreed to be paid. So now GST, we all know that GST is applicable on the tax point, the point of taxation in GST is supply. In excise duty, it was production. So even if you're producing goods at one of your factory or in one of your unit and you are transferring to another unit, excise duty was applicable, but sale tax was subject to sale, so it was not applicable in normal circumstances. But in GST, supply is important. So if you are supplying product from one of your factory to another factory, logically, although I will discuss in detail, I'm coming to that point, GST is applicable. So in CAS 4, when we transfer goods from one unit to another unit, after calculating the cost as per CAS 4, GST is applicable in normal circumstances, except one exception is there that I am coming to that point. So under GST, tax is collected on the supply of goods. And moreover, whether it is a free supply without consideration or which will be paid up. Now, under the GST law, stock transfer is taxable, as we discussed just now, and covered in the scope of supply. So, if you're transferring your stock, it is covered under the definition of supply and it is taxable. The term supply under GST includes transaction between a principal and agent also. Now, as per Schedule 1 of GST law, a supply of goods by a taxable person to another taxable person or non-taxable person during furtherance of a business without consideration is also included within the ambit of supply. However, GST is chargeable if transaction take place between two persons with different GST numbers, GSTs. Now here is the important point. Now we are transferring. It is CAS 4 is asking. CAS 4 is discussing the cost of goods which is being transferred from one unit to another unit in the same company, and this transfer is coming under the purview of supply, under the definition of supply. So if you see the supply definition of GST, you can say that that this supply will attract GST, and it is quite natural. It is quite natural. But another provision of GST Act is that GST is. I am coming to that point. It says that supply of goods by a taxable person to another taxable person or non-taxable during furtherance of business without consideration also included within supply. However, GST is chargeable if transaction take place between two persons with different GST acts. Means if one party is having one GST, same GST, you see, I think you know very well that if our business turnover crosses certain, limit, if annual turnover crosses certain limit, usually it is 40 lakh rupees, then we have to obtain GST number. Becomes mandatory for you that in the previous year, if your annual turnover has crossed the limit, then you have to obtain GST. Now, if you are one company, maybe you are having two units, but you have one company, then you have to obtain GST for the company as a whole. So you can have one GST. So in one GST, if you are having one GST, then what is happening? One department is transferring goods to another department, but the company as a whole, there is a one GST number. But further GST Act says that if even one company is doing business in different states, then we have to obtain state-wise GST. If you see the GST number of any business organization, it is consisting of 15 digits or 15 elements. First two indicates the state. If my company is working in two states, suppose in the state of Jharkhand and the state of Bihar, then I have to obtain two GST number, one of Jharkhand, another of Bihar. Now, the situation may be that I am one company and I am having three units, A, B, C. A is producing certain products or services which will be consumed by B and C both. I am a Jharkhand based company, so my GST number is of Jharkhand. My unit A is in Jharkhand, unit B is in Jharkhand. So unit A is transferring goods to unit B. This is the one case. But my unit C is in Bihar. So my company is same, but my unit is transferring certain goods to unit B, which is in Bihar, which is in Jharkhand itself, and it is also supplying to another unit of my company, which is by chance in Bihar, not in Jharkhand. It means they are having different GST number. So in the same company, the stock transfer may take place when you are transferring goods, although the unit of your company itself, which is having same GST number or another GST number. So in the same company, for one company, we can have two GST, three GST if they are working in different states. So now your stock transfer may be taking place of the unit of the same company, which is coming under the same GST or which is maybe coming under the different GST. So this problem is this complication may be there. So GST says that that under the GST regime, GST is levied on supply, including transfer to distinct persons. Now we are trying to discuss the GST nitty-gritty so far CAS 4 is concerned. Under the GST regime, GST is levied on supply, including transfer to distinct person. Now we have to understand the definition of distinct person. Again, I am repeating the problem. Again, I am repeating the problem which we are going to discuss. In CAS 4, we are producing one product in one unit and it is being transferred to another unit of the same company. Now that another unit may be a distinct person or may not. Then what is the difference? What is the definition of distinct person? That we are going to explain because GST applicability will be different. Under the GST regime, GST is levied on supply, including transfer to distinct person. Such transfer are taxable under the cases listed below. Now we have discussed stock transfer between state, that is interstate, stock transfer and organization under the same PAN between the two branches or units located in different states will be liable to GST. It means it is saying that if, again, I am trying to explain it, I hope you will not mind my way of explanation because, when you teach students, because I teach these things to my students, so I have developed this habit. I hope you will not mind by this habit. If anything is not okay with you, please forgive me. Now it means again because when we talk to students, I want to discuss with the real case studies. So suppose my company is working in Jharkhand. It is registered in Jharkhand, but is also doing business in Bihar. So my company is having two GST number, one of Jharkhand, another of Bihar. Now my company is having three units, Unit A and B. These two units are in Jharkhand, and Unit C is in Bihar, in different states with another GST number. It means Unit A and B are working under same GST number, and my Unit C of my company is working with a different GST number, that is of Bihar. Now, my department Unit A is transferring goods to Unit B. Since both are in both are in Jharkhand, and both are having same PAN number as well as GST number. So here the problem is that GST may not be applicable. That I am coming. But first understand the second situation. When my company is transferring any product of Unit A to Unit C, since PAN number is same but GST number is different. A is of having GST number of Jharkhand and B is having GST number of Bihar. Here GST will be applicable because in this type of stock transfer, GST is applicable. So if we are transferring any goods under CAS 4 to our units which are having different GST number, then GST is applicable. But the stock transfer within the same state, that is interstate, where the GST number is same, the transfer is liable to GST only when the organization is registered more than once in one state. Now, sometimes there is another provision in GST Act. Now, I am again coming to our example. It means I was giving the example that two unit of my company is in one state, that is Jharkhand, and third unit is another state, that is Bihar. And one unit of my state, one unit of my company is Unit A, which is in Jharkhand, is supplying goods to another department, another unit of same company, which is Unit C, but of different state. Since GST number are different, here GST is payable. On stock transfer, GST is payable. But if my Unit A is transferring goods to Unit B, which is in the same state and having same GST number, then GST is not applicable. This stock transfer will not attract GST. But it is also under GST Act, it has also been advised to the companies that even if you are working in the same state, but you are having different nature of business, then you can have different GST number according to the nature of your business. It means if I am doing two businesses, company is same, but I am doing two businesses in the same state, I may have two GST number, one GST number for each nature of business. In this case, even the state is same, PAN is same, everything is same. But since GST number has changed, so unit B is in Jharkhand is working. Unit B of my company in Jharkhand is working with another GST number, and unit A is working with another GST number. So transfer of unit A, stock transfer unit A to B will be subject to GST because GST number is different. So GST Act says that the stock transfer is subject to GSTINs. If GST number is changing, then it is subject to GST. GST will be applicable. Further, generally GST is levied on the transaction value of the goods when the price is the only consideration received for supply and when supply is not between distinct or related persons. Consequently, on stock transfer, the value of the transaction cannot be applied as it is supplied within the same entity's branches, which is considered distinct person under GST law. Hence, for branch transfer, the value of supply needs to be computed by applying the matrix below. Now, here is some confusion. Here, you may have some confusion. Now we have understood that so far stock transfer is concerned. Even in the same company, if one unit is transferring the goods to another unit which is working with the different GST number, then GST is applicable. Now, as we all know, GST is applicable on taxable supply. So first we have to know the taxable amount. Now, the problem is if I am selling any product to outside party, to distinct party, another party, third party, to a customer, I know the selling price. Both the parties know the selling price. And GST is applicable on that selling price. But in case of stock transfer, the problem arises that what will be the price? What will be the transaction price? Because GST is applicable on that transaction price. Now, if we are following CAS 4 and we're doing the valuation of our stock transfer as per CAS 4, then normally the GST will be applicable on that value. So it should be acceptable to all, to the GST authorities also. But here GST Act has certain more provisions. Now let us discuss those two or three provisions also so that we should have a clear-cut idea. GST Act says that on stock transfer, the value of the transactions cannot be applied as is between supplied with the same entity's branches, which is considered distinct person under GST law. Distinct person means because they are working under same company, but they have different GST number. If they were having same GST number, as I told to you, then it would not have been treated as distinct person and no GST was applicable. Hence, for branch transfer, the value of supply needs to be computed applying the matrix below. Now, GST Act says that if there is a confusion on the transfer value, then following matrix can be applied. Now they have given certain guidelines. What are these guidelines? It says that we can adopt open market value. If suppose for the department A is supplying certain goods to department B, and department A can also sell the goods in the market, so price is known to everybody. So that market will be taken as transfer price. So open market value. Or second, it says that value of supply of similar goods and services of similar quality. When the open market value is not available, this method may be applied to arrive at the value of such transaction. Where open market value is not applicable, then we can always, we can take the value of similar type of goods and services. And third guideline is that 90% of the price charged for the supply of similar goods and services of similar quantity to by the recipient of such goods or services to the customer who is not a related person. This metric is available to the supplier's discretion and is applicable solely in the cases where the recipient further supply such goods. So basically, so far GST is concerned, under CAS 4, what we are doing, we are calculating the cost of stock transfer. And generally, if we are calculating and cost accountants are issuing the certificates, then for GST purpose, I think that will be acceptable. There should not be any dispute. Otherwise, some guidelines have been given, but that is not our subject matter. That is the guidelines of GST. GST Act further says that GST has mostly had positive impact on stock transfer, except that is increases working capital. Now, so far stock transfer is concerned, one GST impact is also there. Friends, before the GST and pre-GST regime, as we were discussing, that only excise duties were applicable, not sale tax. But after the GST is a combination of both excise duty and sale tax, previous sale tax, or whether it was VAT or sale tax. Now, after GST, since it is a combination of excise and GST both, and in stock transfer, GST is applicable. It means if one unit is transferring goods to another unit, first they are paying the GST. It means your capital, working capital is getting blocked. So that is another impact of GST on stock transfer, valuation of goods under CAS 4. That our, the chances of, you know, getting the working capital blocked, because no, earlier suppose there was a 6%. I give you the product coal. I was working coal. At that time, 6% was the excise duty and 5% was the sale tax. So in stock transfer, 6% was applicable, 5% was not applicable. But suppose now in coal, the by chance it was GST is 5%. But suppose if it was 5%, suppose, but had it been 18%, or 12%, whatever at that time before the year, then you can say that GST has increased and full 12% will be applicable, because in a stock transfer GST is applicable. So if you are paying more GST even in stock transfer you are paying GST, so your working capital is getting blocked. So that was the negative point so far stock transfer and GST is concerned. And it has not been rectified. It is still there. It is still there. And in the new GST regime, we are no relief had been given. So we have to improve the strategy and we have to improve our utilization process, so that we should try to that our blocked amount should be in the lower side, in the minimum side. So it means stock transfer between distinct person interstate supplies are taxable under GST. What we discussed. These create upfront tax liability with ITC available only post actual sales, creating need for additional working capital that I was discussing, because ITC is available when the goods are actually sold. So in a stock transfer, but yes, in a stock transfer also ITC available. But first we have to pay the GST, then we will get the ITC. Because first we have to pay the GST, then we upload the bill in the in the GST portal. The next month ITC is available. So our that is the only thing negative point of stock transfer concern, that your working capital get blocked. E-way bills are also applied for a stock transfer where consignment value exceeds the threshold limit. This is another complication, that e-way bill was introduced in the GST regime, and once your inter-department transfer, means your stock transfer increases the threshold, then we have to create e-way bills also. So for ITC is concerned, yes, it is available in the Now, friends, this was my discussion on cash flow and GST. Now, I invite any query, any point which you want to discuss with me. Bhavna ma'am, are you there? Hello, friends. Would you like to discuss any point, anything on this topic with me?
Sir, there are few questions.
Hello,
Q&A. Hello.
voice is not coming. Hello,
Hello.
please speak loudly. Your voice is not coming.
Hello.
Yes, Bhavna ma'am, you have to
Sir, am
speak
I?
loudly.
Sir, there are few questions in Q&A section. You
Okay.
can found that On the top right corner.
Mr. Anil Singh Patwal, his question is, I am reading. In a stock transfer under GST, whatever the transfer price is between intercompany is considered transfer price, GST charge, another related company takes input credit. There is any cash for relevant here? Yes, sir, it is relevant here. Anil Singh's question is very, very valid. Mr. Patwal, CMA Anil Singh Patwal, your question is very valid because this question is usually asked by the cost accountants that if in GST stock transfer is between intercompany, but the cash flow is relevant to but question is asked that why is cash flow relevant, and if yes, why? Now, Mr. Patwal, you have already mentioned that under GST regime, the GST is applicable on transfer price. For the calculation of transfer price, cash flow is irrelevant. Without cash flow, we cannot calculate the correct transfer price. So, my reply to your query will be that yes, cash flow is very, very relevant. So far, correct transfer price calculation is it is concerned. So it is relevant. Now, another question is of Mr. Vaidyanath. Under GST, businesses can typically claim a credit for taxes paid on inputs. Cash flow incorporates this principle by requiring that the cost of material consumed should be reduced by any recoverable duties and taxes. Issue with GST authorities not allowing RTC in certain cases for non-payment of GST by supplier. It will have impact on the cost arrived at. How to deal with such cases? So far, Mr. Vedanthan, so far I am getting from your question, you are saying that issue with GST authorities not allowing RTC in certain cases for non-payment of GST by supplier. If it is the case, so far I know, the only solution is now suppose I come to our problem. Suppose my unit A is transferring goods to unit B and it is subject to GST. Then unit A will pay the GST and they will file they will upload their invoice. So unit B will be able to get if they are having different GST number, they will get the ITC. If you are purchasing anything from the outside market and supplier is not uploading I think that be the case. If if you are denied with the ITC, there may be two cases. Either ITC is not applicable on that product, means that product is not for your business or not for furtherance of business, or the supplier has not uploaded the bill. They have not, after the supply, they have not shown the invoices to the GST authorities. Means they have not uploaded. They have not showing their bill in the GSTR1. In this case, I don't know. We are having a lot of experts are here, but in my opinion, we have only one option. We have to chase with the supplier that upload otherwise we have to make a complaint. We have to chase with the supplier, with the seller to ensure that all the bills are uploaded so that we can get the ITC in due course of time. Now, Mr. Vedanath further says that if I am right, in certain cases, if the sale of goods that have become exempt, a business may need to reverse previously claimed ITC. This reversal increases the cost of production. If the sale of goods that have become exempt, a business may need to reverse previously claimed ITC. Mr. Vedanath, I think if this is a very exceptional case, and if this is the case, definitely one date will be announced by the government that from this date this product will become exempt or this service will be exempt, and from that day only, ITC will not be applicable. So my reply is that the reversal will be they may be there only from the date cutoff date, from the date in which the product will become exempt. So your question is partly correct, But usually these type of dates are always have prospective impact, not retrospective impact. In GST, I have hardly seen any retrospective decision. Well, I mean, any decision which has been implemented retrospectively. So, sorry, I hope you will not mind my words. I am not fully agreeing with you. Uh, if the government announces the date in advance, so from that date, definitely you will not get the benefit. But whatever benefit you have already claimed before that date, I think there will be no impact and you will get the benefit. Mr. Kailash Pathak has written that in pharma industry, online batch failure and reprocessing cost should be considered as cost of production normal losses. In pharma industry, online batch failure of, and reprocessing cost. Sorry, I could not get your query, Mr. Pathak. Can you retype your query exactly? From your question, from your words, I am not getting the problem. In pharma industry, online batch failure. Online batch failure means and reprocessing cost should be considered. Online batch failure, that I am not getting. Reprocessing cost should be considered as cost of production or abnormal loss. So I cannot give you the answer of simply this one line question. Mr. Pathak, you have to explain the question in detail. Only then I think I may be in a position to reply your query. Do we need do we need to send invoice for inter-department material movement? If you are logically as per GST, the supply should be accompanied with the invoice. But and moreover, if your supply is crossing the threshold limit, then you have to generate e-way bill. See, in e-way bill, I think this question is not valid. E-way bill is there. But if there is no e-way bill, then it is an intercompany transfer. So physically, to be very frank, practically, even the physical bills or bills are not moving with your material. I think it should not create any problem. But if you see the GST Act holistically, then then my answer will be yes, we should send invoice for with all the material transfer. How should we relate various GST audit to cost audit? How should we relate various GST audit to cost audit? Again, I am not getting your question because right now GST audit is not being done by the cost accountant because GST audit is not there. Government has not implemented GST audit by professionals. A special audit is there, of course, but I think if you ask me personally, yes, there is a very close relationship between GST audit and cost audit because GST is fully GST is payable on the transaction value. And whenever transaction value will the picture, whenever transaction value will come into the picture, then cost will come into the picture. Because many companies or many parties may tend to reduce the transaction value, may show the less transaction value only to save the GST. So logically, there is a very close relationship between GST audit and cost audit. Rather, I think government should focus on GST audit plus cost audit. Rather, government should involve cost accountants for GST audit because there is a close relationship between, in my opinion, it's my personal opinion. You may agree, you may not agree. There is a close relationship between GST audit and cost audit. Now, which are Mr. Dilip Bhathija is asking, which are relevant sections of GCGF state on GST state? You only see the supply. Mr. CMA Dilip Bhatija, Mr. CMA Dilip Bhatija. Yes, I am pronouncing correctly. You simply see the supply chapter, supply, portion of CGST Act, IGST Act. Supply portion of CGST Act is related with your CAS 4 because only it is a question of supply which covers everything, supply value, time. So supply is the related relevant section of CGST Act. So for our today's discussion is concerned. Mr. Siva Sankran, can we Can we do stock transfer at cost price from one branch to another branch in a different state? Yes, why not? We can do. Basically, in intercompany transaction, in the intra-company transaction, cost becomes the main point, because in what happens practically, I am giving you the practical thing, that in a company, two different departments work in two different head of departments, and everybody wants to improve their you know performance. So cost is the correct method. So I think my reply to your query will be yes. This is related to department consideration. Department will take us up the matter. Is the department seriously taken into account? The answer is of course correct, but I think if department is having some confusion as a cost accountant, we can help the department that yes, cost price is the right thing. And if you have any doubt on the cost price, then you take the help of cost accountant and cost auditor. That is my suggestion to GST department. That if you have any doubt on the cost price as a transfer price, you are having any doubt that there is some problem in the cost price and transfer price, then definitely you should take the help of cost accountants. We are more helpful to us, to the GST department. Only problem is that we have not successfully sold our brand. So that type of problem is coming. Otherwise, Mr. KK Joshi, what is the impact if the goods are transferred to another unit of the same company at any cost, whether cost of production or any other value? Because ultimately final GST is paid in the consuming state. You are very much correct, but so far in GST, ultimate GST paid by GST has to, GST is goes to, consuming state where the product ultimately stand. So you have to calculate GST where, because input tax credit is also involved. So, so cost of production or, transfer cost should be accurate. So I am not agreeing to your point that what is the impact if the goods are transferred to another unit of the same company at any cost, because then GST collection, GST calculation plus ITC will be impacted. So I am not agreeing to. We have to calculate the transfer price very correctly. So for GST is concerned. Otherwise, any short payment, because money revenue is not important. Important is law. If we are not showing the transfer price correctly, we are not calculating transfer price correctly, then it will be a case of short payment of GST. And it is another offense. If you see the offenses and penalties under the GST Act, short payment and short calculation of transaction value is an offense. So that is the reason I am not agreeing to you. Now, Mr. Mangesh is saying that we are working on backward integration of products. Okay, this is correct. So these were the queries where I have given my views. As I told you, friend, I am not an very expert. I am like any other cost accountant. I am doing the practice. Since I am dealing with these problems, earlier I was working in a company where I was dealing with this kind of things. So that is my opinion. And I am also, dealing with the cost accounting standard. So this was my opinion. If you have any other opinion, you are most welcome, sir. You can update me also. So this was my presentation. And so for queries concerned, this was my reply. Ms. Bhavna.
Thank you, sir, for such an engaging and insightful session. I hope all of you found today's webinar informative and enriching. Thank you, sir. Thank you so much.
Thank you. So can I sign off, Madam Bhavna?
Yes, sir.
Okay. Thank you very much. Thank you for your patient hearing. Thank you very much. Bye. I wish you all the best. Thank you.